business finance. In that, the first area, it is going to be A, sources of finance. So under source of finance, the first thing that you have, which is short-term finance. Under short-term finance, what are the things that you should know? First one is overdraft, short-term loan, then you have short-term lease, then you have trade credit. Then next you have long-term debt finance. So under the long-term debt finance, you have bank loans, normal long-term bank loans, and long-term lease and loan notes or debentures, another name, or bonds. Under loan notes, debentures or bonds, you should know three things. One is the redeemable bond, other one is the irredeemable bond, other one is the convertible bond. And your bonds can be zero coupon bond, and you should know what is deep discount bond as well. And to make the bonds attractive, another element which is connected with the bond, which is warrants. If not to make the debentures attractive, another element, the companies are offering something called warrants. You should know what is that as well. The next one that you should know is equity finance. Under equity finance, you should know about the initial public offering, if not the normal share issuance. The next one, private placing. Next one, preference shares, and you may include venture capitalist and right issue. Under preference shares, you should know what is cumulative preference shares and what is non-cumulative preference shares. And when it's come to the right issue, you should know how to calculate the theoretical strike price, which is the term, and how to calculate the value for right, and you should know how to calculate the value for right for the existing share. Next, you should know elements to consider when choosing an equity finance. So if you are selecting one of the sources of equity finance, what are the elements that you have to consider? And the next one, the fourth one, internally generated finance. If you need money, if you need finance, you can use your internally generated finance as well. Under that, the first one that you have, which is the retained earnings, then you can generate money inside the company itself by managing the working capital properly, and maybe by changing the, or not changing, only by using the dividend policy, by using the dividend, By using the dividend, you can generate some finance internally. Here you can use things such as maybe scrip dividend and using the dividend policy. So under the dividend policy, the things that you should know, factors to consider when formulating dividend policy. And you should know the factors to consider when changing the dividend policy, such as client effect, such as signaling effect. And you should know types of dividend policy, maybe constant dividend and constant payout and stable growth and zero dividend. And you should know the residual policy. Further, you should know dividend, irrelevance theory. Under that, you should know assumption. What is the theory you should know first, and you should know assumptions and limitations of this particular theory. Apart from that, you should know what is manufacturing dividend. Further, you should know what is this bonus issue and the stock split is. Under stock split and bonus issue, what is the impact it is creating on the finance availability for the business? Is it creating an impact or not? You should know that one as well. Under part A, fifth area is Islamic finance. If you need money, another source of finance that you have, which is Islamic finance. Under that, you should know what is this murabaha and mudaraba and musharaka and ijara and sukuk. And you should know under Islamic finance another two important elements. First one is riba. And what is this Islamic finance is? Yes, I know these terminologies are not easy to remember, but can't help, you got to remember these terminologies, and you should know what are these terminologies meanings are. Okay, part A is source of finance, part B is cost of capital. So here mainly we are going to focus on how to calculate the weighted average cost of capital. So to calculate the weighted average cost of capital, you should know how to calculate the cost of equity source of finance and cost of debt source of finance. So under equity source of finance, you have two. One is the normal ordinary shares, other one is the preference shares. To calculate the cost of ordinary shares, which is the cost of equity, normally we will call it as, you will have two methods. One is the dividend valuation model, other one is the capital asset pricing model, CAPM. So for the preference shares, we will be using the cost of preference shares, and you have to calculate the cost of debt. So we have to calculate all these percentages to calculate the weighted average cost of capital. When it's come to the debt, we should know four areas. One is the cost of debt of the irredeemable debt, cost of debt of the redeemable debt, cost of debt of the convertible debt, cost of debt of the normal loans. So do remember, when you are doing the calculations for the weighted average cost of capital, especially when it's come to the debt, always you have to take after tax values. If it is business valuation chapter, you have to take the pre-tax values. In the business finance chapter, when you are calculating the weighted average cost of capital, always you have to take the after tax values. That means after taking 1 minus t into consideration only, you have to get these values. When it's come to the dividend valuation model, you should know certain things such as limitations of the dividend valuation model and how to calculate the growth which is needed for the dividend valuation model. So growth can be calculated in two ways: using the average growth rate over the past period, and using the Gordon model you can calculate the growth. And apart from that, you should know how to calculate the X price. Then you should know what are the assumptions used in the dividend valuation model. So these are very important 4 things that you have to remember when it's come to the dividend valuation model. Same as with the CAPM model, there are certain things that you have to remember. What is this systematic risk and what is this unsystematic risk? What is this diversification and the portfolio theory and assumptions and disadvantages and advantages of the capital asset pricing model. And you should know what is this beta value is. Now let's get into little bit in depth of the weighted average cost of capital calculation. Weighted average cost of capital, and under that we have equity. Under equity, the first one, ordinary shares. Under that, dividend valuation model, how to calculate the cost of equity. So let me use a different color. Cost of equity equals D0 into 1 plus G divided from P0 x P0 plus G. Then next what you have the dividend valuation model. After that, capital asset pricing model. Under the capital asset pricing model, to calculate the cost of equity, risk-free rate plus beta into RM minus RF. So for the RM minus RF, a common name that we are giving, it is the risk premium. Then next you have the cost of preference shares. So preference shares, how to calculate the cost of preference shares? Cost of preference shares equals preference share dividend. So how to calculate the preference share dividend? The nominal value into the preference share dividend percentage divided from the market value of preference share. Next you have the cost of debt. Under the cost of debt, the first one you have the irredeemable, then you have redeemable, then you have convertible, then you have the normal loans. How to calculate the cost of debt? For the irredeemable, interest into 1 minus t divided from x market value of irredeemable debt. The redeemable debt cost of debt equals IRR, but here you have to take the after tax interest when you are doing the calculation. Under the convertible also same, cost of debt equals IRR. Here also you have to take after tax interest when you are doing the calculation. For the normal bank loans, how to calculate the cost of debt equals interest into 1 minus t. Okay, part A is source of finance, part B is cost of capital, part C is further aspects of business finance. Under this, what are the things that you should know? First one, debt versus equity, advantages, disadvantages. Next one, you should know what is this creditor hierarchy is. Next one, you should know what is this financial gearing. So if you take gearing, there are two things. One is the financial gearing and other one is the operational gearing. So financial gearing is your financial risk, operational gearing is your operational risk. and advantages and disadvantages of having high gearing and having low gearing, and using different sources of finance, how it can impact the equity holders, how it can impact the debt holders. So how to do this analysis using the ratios, that part you should know. And you should know what is this reverse yield gap is. You should know what are the situations that you can use the existing weighted average cost of capital to appraise the new investments. And further, you should know how to deal with the project specific weighted average cost of capital. Under this, you should know what is this asset beta and what is this equity beta. Another name that you are giving for the asset beta is ungeared beta. If not, we'll call it as earnings beta. Another name that we are giving for the equity beta is the geared beta. If not, we'll call it as the share beta. And you should know how to get the project specific weighted average cost of capital using the beta and using the capital asset pricing model. So how this asset beta, equity beta will work with the capital asset pricing model. You should know that one as well. If you are trying to find out the cost of equity for a specific project using the CAPM model, what are the steps that you have to follow? Step number 1, ungear the proxy company and find the beta asset. And step number 2, re-gear the new investment company, if not the considering company, using the answer which you got in step number 1, using the asset beta that you got in the step number 1, using the financial, that means simply the asset beta that you got in the step number 1, and using the financial risk of the considering company. By taking these two factors into consideration, re-gear and find out the beta equity. And step number 3, using the answer that you got in step number 2 and using the capital asset pricing model, that means using this beta equity and using the capital asset pricing model, which is risk-free rate plus beta into RM minus RF. So for this beta, you can use the answer that you got in the step number 2. You can find the cost of equity for a special project. And the next main area that you should know, it is capital structure theories. So under this, we will be focusing on the first theory, which is the traditional. Under the traditional theory, what you have to understand, the cost of equity, if this is your gearing, if this is your rate, when the gearing increases, the cost of equity will increase. And when the gearing increases, the cost of debt will be constant. After a certain point, it will start to increase if the gearing is very high. And what will happen to the weighted average cost of capital? It will drop up to a certain point. After that, it will start to increase. Why? The weighted average cost of capital is reducing from this point to this point, because the debt is cheaper. Since the debt is cheaper, it is creating you a higher benefit than the additional cost demanded by the equity holders because of the higher risk. So this particular point where your cost of weighted average cost of capital is the lowest, we will call this one as the optimum or optimal capital structure. Optimal capital structure. So in traditional, we have 3 things you got to remember: cost of equity increasing, weighted average cost of capital decreases, after that it will increase, cost of debt is almost constant. Weighted average cost of capital lowest point, that is the best capital structure that you have to maintain in the business. And the next one that you should know, it is the MM theory 1. So under MM theory 1, they didn't consider the tax, so it is the without tax theory. So under MM theory 1, They came up with the formulas, they came up with numbers. When the gearing increases, what is happening to the cost of equity? Cost of equity is increasing. When the gearing increases, the cost of debt is constant. And when the gearing is increasing, and they came up with certain method, technique where the weighted average cost of capital also constant, where it is not changing. And the next one is Theory 2. Under Theory 2, they consider the tax. So it is the with tax method. Under this, what they said was, in the Theory 1, they couldn't consider the tax saving which they will be getting because of the debt. So cost of equity is same. When the gearing increases, cost of equity increases. The debt, it is same as the previous. And what is happening? Because of the debt, you will have interest, so you will have tax savings. So it is creating your lower cost. So when you are having more debts, your weighted average cost of capital will start to go down. So what you have to understand as per these three theories: first one, the traditional theory. Under the traditional theory, we have to find out our best capital structure where the weighted average cost of capital point is lower. So that is the optimal capital structure, which is the weighted average cost of capital lowest point. And under the Theory 1, since you go for the equity, even you go for the debt, even you go for the equity, there is no change in the weighted average cost of capital. You can select any option to finance. You can go ahead with debt or equity. You can go ahead with anything. According to the Theory 2, when the gearing increases, your weighted average cost of capital is decreasing. What they said was, you have to obtain your finance much as from the source of debt. So according to the traditional theory, if you have a question, okay, am I going to proceed with debt or equity? Then the optimal capital structure, the percentage of debt, 40% debt, 60% equity, 30% debt, 70% equity. So that particular structure will be given where the weighted average cost of capital is the lowest. Under the Theory 1, you are not required to bother about are you going to proceed with the debt finance or equity finance, because your average cost is going to be the same. Under the Theory 2, when you take more debt finance, since your average cost is decreasing, what they said was, okay, you have to obtain your finance as much as from the debt sources. If I am talking little bit in depth of this Theory 1 and Theory 2, as per this, if you take the weighted average cost of capital under the Theory 1, it is constant, and under the Theory 2, weighted average cost of capital is decreasing. And if you take the market value under the Theory 1, since your average cost is constant, your market value also going to be constant. But under Theory 2, since your average cost is decreasing, what's going to happen to the market value? Market value is going to increase. So do remember, Theory 1, weighted average cost of capital and market value constant. Under the Theory 2, weighted average cost of capital decreases and the market value increases. And apart from that, with regard in the traditional theory, with regard in the Theory 1 without tax, Theory 2 with tax, you should know the advantages and disadvantages of each method. And further, especially you should know certain assumptions that they have made in Theory 1 and Theory 2 as well. And the final theory that you should know, it is the pecking order theory. Under the pecking order theory, the first thing that you have to see whether there are any internal funds. If you don't have any internal funds, you can go for normal debt. As the third option, you can go for the convertible debt. As the next option, you can go for the preference shares. Next option, you have to look into the new equity shares. When it's come to the use of the normal debt, you have to see, are you going to proceed with the unsecured loans or the secured loans? Unsecured loans means like without backed by an asset or the collateral. Secured loan means backed by a collateral. Normally, a higher priority will be given for the unsecured one without a collateral only. You will try to proceed with this loan. And the final main area that you should know, it is the financing for SMEs. Under the financing for SMEs, the first area that you should know, what is this funding gap and what is this maturity gap. And the next one is the sources of finance for the SME. So apart from whatever the source of finance that we discussed in the part A, you can use these source of finance for the SMEs such as business angels and crowdfunding and peer-to-peer funding and supply chain finance. And finally, you should know how government can help SMEs. So this is a quick or express summary of the section which is business finance.